So welcome everyone. I think we're in for a great session today that I think was teed up as renew and development finance. And I think that could go in any number of directions, and we have some thoughts and we'll introduce some topics, but then would really like to just open it up to the larger group and the larger discussion, because I think there's a huge amount of expertise broadly in the room. I think the one charge that I had as moderator was to keep time, and I forgot my watch, so already borrowed a watch for this morning. My name is Georgia Levinson-Cohen. I'm the Executive Director of the Pershing Square Foundation, which works in the development field, both using grants and investments. I'm relatively new to Pershing, came in May, but I also teach at Columbia Business School in the Social Enterprise Program, and recently just wrote a new book called Capital and How Innovative Finance is Tackling the World's Most Urgent Problems, or something close to that. So I think I was asked to moderate because I know a little about a lot, and I think that we have here people who know a lot about a lot, and I'd like to sort of introduce a really terrific panel, and then I just think that really let folks talk a little bit more about their own expertise and where they really think some interesting evolutions are taking place in both in development and in finance. I'm not always sure that they're the same things, and I think we're going to mostly talk from an investor perspective today, but I'd also like us to consider perhaps the SME, the business perspective, if and how we're seeing the finance world evolve away from credit, perhaps, to other products and services, perhaps the role of technology and policy. I think there's a lot that we could talk about. Let me give some brief introductions, and then I will open it up to birds. Next to me is Peter Bernard, who's COO of Root Capital. As you know, but many of you have, Root is essentially an agricultural impact investment firm focused on capital, technical assistance, and I think marketplace development. Peter is relatively new to the COO role at Root, but has been a board member for a long time, and has really spent a career in various iterations in the financial service industry as an investor and specialist in sort of risk management. Most recently at Dean Shaw, also at Alpha Simplex, and has spent a long time at JP Morgan and elsewhere. So that is a welcome perspective. Thank you. Next to Peter Smith, who's the Managing Director of Risk at Microvest. Many of you, I think, probably know Microvest asset management firm focused on getting capital to microfinance institutions that then really think about financial inclusion in many parts of the developing world. Candace has spent a deep career in the client development space. I believe came to Microvest in 2005, initially as CFO, COO, has had several roles there, but also leadership roles and both advisory work with a number of development finance institutions, the Inter-American Development Bank, Calvert Social Investment, Triodos, extensive, long, and illustrious list. So I'll let you speak to that, but welcome that perspective. And then finally, we lost Tara Higgins. I'm afraid she had a personal circumstance that she had to attend to this morning, but we won't hear from her. But Vivina, welcome. Vivina Burla is a co-managing partner at Serona Asset Management. Again, another investment firm with an eye on financial inclusion and capital to entrepreneurs in countries that reach the underserved. Vivina, like Peter, comes to this sort of impact space, I think, from a long career in the more traditional investment world. Numerous places, including Merrill Lynch Investment Managers and then Gartmore, but also comes from Europe, right? You're based in Amsterdam. And I do think it'd be interesting. I think that we are sort of, as we think about the impact investing marketplace and how it's developing in the U.S., it looks and feels a little bit different, I think, than some of the hours in Europe. So now I will hand off, but I guess I'd love each of you maybe take a couple of minutes. And if you could give a little bit of color as to the work your firms do and your organizations do, and why. And I think particularly, we talked about this a little bit from a capital perspective and sort of who the investors are you increasingly see in this space. What evolutions have you seen since you've been doing this work? Yeah.
Thank you, and good morning. So Root Capital is a 17-year-old organization that attempts to stabilize rural communities and raise farmer income. We do that by addressing both the supply and the demand for capital in small and medium agricultural enterprises and cooperatives and associations throughout Latin America, Africa, and to some degree in Asia. What do we mean by supply and demand of capital? The demand of capital, we supply a wide range of advisory services to the enterprises that we work with, and those advisory services range from cash flow and inventory planning on the finance side to kind of broader agronomic and even fintech advisory in order to increase the capital absorption capacity of those enterprises. On the supply side, we bring capital. We are a lender with several different kind of lending products to those organizations. Our loans tend to be in the $100,000 to $5 million range to those organizations. We try to pick out fast-growing, ultimately successful organizations that are in kind of an early stage of development. When Georgia asked us to speak to kind of what's front of mind and how we're developing within our organizations these days, I thought I'd talk about one thing that's really been attracting a lot of interest internally. I hope it attracts a lot of interest externally as well. And I'll be more kind of financy for this crowd than I would be normally, because you guys will know what I'm talking about. We all spend much of our careers getting comfortable with trading off risk against return, right? When one enters the impact space, there's another dimension that makes it quite difficult to limit yourself to risk and return, and that's impact. And for some time, the industry has grappled with how to bring impact into that equation, how to think about what you give up in return, what maybe extra you need to take in risk in order to achieve some level of impact. And it's been difficult. It's been a hard nut to crack. It doesn't get measured on the same with the same units as risk and return. So we've done a lot of work recently that is pretty specific to what we do, but may have in different guises broader applicability, and I want to describe it a little bit. When we put together our loan portfolios, we achieve, like any lender, try to achieve a degree of diversification. But the way we are underwriting loans these days has changed significantly due to some work we've done on impact recently. Now when we underwrite loans, we measure three different things at the outset. We measure the revenue we expect to get from the loan. We measure the risk we have in taking the loan. And by doing that, we look at the probability of default. We've got our own kind of homegrown probability of default model to figure that out. So if you add those two together, the expected return and the expected risk, you get a net risk-adjusted return number. And then third, and most importantly, we have created for ourselves an impact index. And so every loan we make, we rate on that impact index. And what that allows us to do is then chart risk-adjusted return against impact and try to move our portfolio over time, both on an individual loan basis and on the portfolio as a whole, kind of try to move that portfolio of kind of dots on risk and return and impact kind of up and to the right. Increase the profitability of our activities because that allows us to lend more the next time around, and increase the impact because that's what we're in business to do. So how do we think about that impact index? We've tried lots of different versions, and we'll probably continue to try them. But what's driving us right now is additionality. So we can all agree on the impact we want is to raise agricultural business incomes. We can perpetuate the capital so it can continue to flow through the system. But what drives our index today, and what's likely to drive it into the future, is additionality. We feel strongly that what we're in business to do is go where other people haven't. And so we're not doing as much good as we can if we lend to enterprises, no matter how sustainable they are, no matter how impact-oriented they are, if there are other lenders lined up to take our place. So we work very hard on trying to understand whether we are the first or one of the few lenders in the picture. And that gets us, on our impact index, bigger points. What that means is that we are driving our portfolio towards the riskier credits, because those enterprises that have the least number of capital alternatives also, not surprisingly, are the riskiest. But that's exactly where we want to be in the kind of landscape in which we work. Let me stop there and pass it on.
Thanks. Microvest, for those of you who don't know us, we're an asset manager. We were founded in 2003. We manage a family of private funds that invest in the emerging markets in financial intermediaries that serve the base of the pyramid. So essentially, the way that I think about our business, we are set up to raise capital in the developed markets from a variety of sources, but primarily private sources. And we're the kind of the bridge that gets that capital to local intermediaries that have figured out how to lend, invest in, do trade financing for, do leasing operations for micro and small businesses in their own communities. Our expertise on the portfolio side is really understanding those financial intermediaries and doing deep due diligence on them. So we pick institutions that both are good at what they do and have a really ingrained kind of social and mission of their own. So I can use Root Capital as an example because we actually have done some lending operations with Root Capital. And so what our expertise is in kind of raising the capital and allocating it to institutions that have the financial and social return that Root and other similar institutions do. So we lend to a variety of different types of enterprises, including microfinance banks, small business banks, and a variety of other institutions. We have about $400 million under management now, and if I think about the way that this market has changed over time, when I joined Microvest in 2005, I think we had $15 million under management, first fund, and it was really had been raised with a very high commitment from the founders of our management company, who included CARE International and NIDA. And through they were kind of very much mission-driven, financial, had a financial investment perspective, but a very much mission-driven focus. As we have grown our funds over time and expanded our footprint, the biggest change, I think, for us as a company is really to expand that investor profile. So whereas we had with that first fund, with our initial $15 million in capital, I think we had 60 investors. A lot of them were individuals or foundations or family foundations that made relatively small commitments, but were kind of on the leading edge of the private side of impact investing at the time. And as our funds have grown, we have been able to demonstrate a track record. We have different products that fit different investor appetites for risk, return, liquidity. We have been able to expand that investor universe to larger institutional type investors. And that, I think, piggybacks a bit on some of the comments that Elizabeth Littlefield made this morning. Our view is that in order to really expand the capacity to invest in this sector, we need to be able to attract private capital. So getting from the public side to the private side is sort of that journey that we've been on. I just wanted to make a couple of comments in line with what Peter described in terms of the way that Root looks at risk, return, and impact. We take not the same approach, but a similar approach. We obviously look at risk and return, and both risk and return of our investment portfolio, risk and return and liquidity of our fund management to ensure that we meet our investors' appetite for risk and return faithfully, and we also can manage our portfolio. We think of our kind of impact screen more as a sandbox, sort of. So we've got kind of a sandbox that you need to be able to fit into that sandbox. So there has to be, as I said, real social mission, driven story from the portfolio investments that we make. But once we're in that sandbox, then we have to evaluate risk and return along that continuum. So we do some fairly high-risk investments, and we do other lower-risk investments that have a commensurate return or impact. So I'll stop there and pass on to Vivina.
So yeah, good morning. It's wonderful to be here, and I don't know whether it's a good thing or a bad thing, but we seem to always be amongst friends and being very related, because the good thing is that we're amongst friends. The bad thing is it's always the same people. and in fact, you know, Candace was saying that Microvest invests in Roots, and then Sarona and Microvest are actually sister companies because we come from the same origins. Candace mentioned MEDA, which is a Canadian non-profit organization that has a 60 years history of investing directly, providing loans and equities to these relatively early stage, very impactful companies across Africa, Asia, and Latin America. And so from MEDA came Microvest, from MEDA came Sarona. Sarona is today a privately owned, independent asset management firm. We did a management buyout. There is actually 4 partners that put their hard-earned saving, gave up their future earnings, and decided to capitalize Sarona Asset Management to scale the business. And you know, whenever you are in the impact investing world, the words "how do we scale" is the constant sort of refrain, and it is difficult to do for a whole variety of reasons. One of them is that usually doing direct investments and providing direct loans and equities to small companies is very costly. And therefore, the original founder of Sarona, who used to be the chief investment officer of MEDA, evolved the model from doing direct investing to actually investing in private equity funds. It is very important for us that these private equity funds are based locally, close to the companies to which they provide equity capital. It's very important to us that these private equity managers are good at what they're doing, because what we find is that unfortunately very often investors who are looking for impact are willing to give up returns, and it's not necessary to give up returns. In fact, one of the biggest battles that I keep fighting ever since I've joined the Sarona team is to try and explain that impact investing comes in all sorts of shapes and sizes and colors and flavors. And they're all important and they're all necessary, but they're all different. And I think we in this community need to do a much better job at segmenting and identifying the game that each one of us plays. And I think here you have 3 panelists plus a wonderful moderator who are actually very different. And yet here we are at the same table talking to you about development finance and impact investing in developing countries. So, you know, root capital, loans directly to companies in the agri segment in these countries. Candace, Microvest, investing directly into financial intermediary who provide loans and or equity to local companies. Sarona is at possibly the opposite spectrum. We are looking for the best possible private equity players to generate private equity returns, while at the same time investing in what has become our tagline. Our tagline is growth that matters. It means equity capital to grow companies in the mid-market segment, growth stage. So we don't do early stage, we don't do large buyout companies. We do growth, mid-market stage to entrepreneurs who have a fantastic business that can become better if only they get the right, quote-unquote, type of capital. And the right type of capital is smart capital, is operationally active capital, is strategically active capital, is capital that comes assisted by private equity professionals who are going to be able to help the entrepreneurs in these countries. And by these countries, we don't invest in China, we don't invest in Russia, but we do invest in countries where the GNI per capita per annum is below 13,000, which is the World Bank definition of low and middle income countries. On the basis that these countries is where we find that there is a real issue of inequality and destabilization at the world level. And if only we could actually help these countries to grow in the right way, then the whole world will benefit and find a more balanced way of sharing in the economic fruits of the right capital. And so I'll stop there, and we'll take it from here.
Terrific, thank you. Why don't I take, can I ask one more question, I think, to all of you, and then maybe we'll open it up. Ruben, I want to get back to your point about how nice it is that everyone's friends, but to your point, some of the problem in growing the field is that it's sort of everyone's friends at the moment, and it's a somewhat closed group. And the question that Kim has raised a little bit, and Elizabeth raised earlier this morning, is how do we expand that circle of friends and really start to think about institutional investors? And I guess my question is, Peter, you raised this impact index, which certainly works for you. You're not necessarily looking to serve markets that are under 13,000. You're thinking about a very different market segment. And for you internally, and perhaps your investors, the kind of impact index that shows impact alongside, risk adjust, however you are measuring the returns works. Would that type of index work for all of you as you think about the institutional investors, or do we need a different set of measurement tools that maybe don't describe index in this? What tools would work?
I can jump in there. As you probably gather, I tend to have strong views on life. I think the whole topic of impact measurement is fascinating, important, and a long way off from being finalized. I would love to know what your impact index consists of. We have done a lot of work because we invest alongside the DFIs. Usually the funds in which we invest are, I would say, 90% of the time backed by the IFCs, CDCs, FMOs of this world. Each one of these DFIs have their own criteria to judge whether the fund is actually behaving as they should and measuring the impact and the difference that they make with their capital. We publish, Sarona, every year, we publish a Sarona annual values with a plural S report. And we try and measure the impact that we have using iris metrics and encouraging our GPs to become gears rated. So we're trying to make a systemic change by investing in funds who in turn invest in companies and ensuring that they try and make a difference and trying to measure that difference. The one thing that is really challenging is how do we, as an impact investment world, rationalize the amount of questions that we ask from the businesses, because we are killing them. These are small companies, usually relatively small companies, that have to run a business. And they are inundated with questionnaires. So what we have done is we're actually working together with the DFIs, and we're trying to actually gather the same information they do and then apply whatever complementary request we have as gently as we possibly can so that we can report to our investors without adding to the burden of the underlying investees.
So thanks, Davina. And so I would say, and looking back, you made some reference to my early career. So I started my career in development finance working for the Inter-American Investment Corporation, the private sector arm of the IDB. I spent about 4 years running an investment fund with a lot of DFI money and some private money that was investing in the solar sector, and I've done done some work with Calvert Foundation and have been at Microvest for quite a while. But going back to my days at the IAC, we had some really simple metrics for defining, I don't even remember the term we used for it. It was probably development impact, because it certainly wasn't social impact, because that term hadn't quite been phrased yet. But it was simple things like kind of the number of jobs attributed to a particular project that we were investing in. So job creation, basic economic activity, kind of revenue growth, kind of the types of things that actually were key factors to the success of the business overall. And at Microvest, we certainly have recognized and have been involved in these discussions around different impact measurements. I think that both for our investors and for ourselves, I think it's an important topic that people need to understand, kind of what is your common understanding of impact and how do you measure it. But it is very difficult to measure impact, particularly in the case of the type of things that Sirona is involved in, when you are investing in industries across the board. How do you equate an energy company and an ag company? It's a little bit easier when you can develop your metrics around a portfolio that has a common theme. And I think that's true for us as well in the financial services sector. The way that we think about measuring impact is that most of what's important in measuring impact is actually the sustainability of the institution. So what is the total kind of loan book of a company that we're investing in? What segment of the market are they targeted to? We often measure the percentage of female borrowers within the portfolio, because that's been a great indicator of development impact in countries. But most of the things that we measure, and we follow the IRIS metrics as well, a select few of them, are really things that for us are important when we're doing our risk evaluation of the company. Because really what is important is that the business is sustainable, that it operates transparently, that it thinks about client protection, it honors both its employees and its customers, and that that's part of kind of our due diligence when we're looking at the company. So I think that the measurement of impact, it's a difficult task. I think that it will be a conversation that will continue, and I think will become more formal. I know that there's a number of initiatives of bringing the various groups together to think about how do we put that into a framework. And it's important to also recognize that investors are going to have their own framework for how important is impact and what type of impact versus risk and return. I completely agree with Vivina, and certainly our perspective is that we don't see a trade-off between return and impact. What we believe is that the types of investment that we make we've made an equation between risk and return, and that many of the factors that we would say contribute to social impact, in fact, go to reduce the risk because they are well-managed, sustainable institutions. And so that's how that equation works out for us.
I'll just add one quick note. Vivina talked about the segmentation of the impact investing market, and I want to give just a minute of emphasis to the part of that market that isn't looking for market returns and feeling good about those investments. At the risk, that part of the market is wonderful and deserves attention. But there are parts of the market, and we in part serve them, where there isn't a market return.
This one.
And I think it's incumbent upon everyone in the room, everyone in this conference, everyone who feels attached to impact investing, to try to ensure that in the future we don't honor each other in the room, that we bring new sources of capital to the table, to expand the universe of philanthropy. Harvard just finished a $4 billion capital campaign. $4 billion of philanthropy due to the investing market, quite a lot. And won't pretend that have the fundraising acumen of Harvard University, but I think that we can certainly expand the universe of people who think that what we do deserves their attention, deserves their input, and deserves their philanthropy.
I'd love to open it up because I know that there are a lot of questions in the room, or comments, observations.
So I'm Trilink Global. We're a similar fund in many ways to Sorona and Microvest, but focused on institutional capital and retail investors. We measure a lot of the same things for the same reasons. Candace, this question is for you, related to how you said that it's important for you to measure how you honor employees and customers. We also use Iris metrics, so I'm curious to hear from you. What specifically are you doing in your due diligence process to make sure that those key points that you raised that do reduce risk, but that can be measured in quantifiable ways?
So we have, sorry, I'm not used to talking on a mic. We have a tool that we've developed over the years that does a score for kind of what we consider social impact score. And that tool is used at the time that due diligence is undertaken. In general, we do field due diligence, if not a deep field due diligence, we always have meetings with the management of the company. And so the things that we are looking at in due diligence are things like their HR policies. We look at the kind of the training that's afforded to employees and any other types of programs that the company has in terms of supporting its employees, and how they measure those things, and what's turnover, what systems do they have in place. We also look very closely at evaluating the board and the board's policies, the committee structure of the board, the transparency of the board, the things that they're focused on, and how that is then reflected in management. So that's part of kind of understanding how the organization works so that we can evaluate the risk of the organization.
And just to complement that, I suppose when we look at managers like Microvest, we look for managers who do exactly what Candace said they do, and then we ask, if the companies are not doing it, what do you actually do about it? Because we do not necessarily invest in managers that invest in perfect companies, but we do like the idea that we can actually make the world a better place by encouraging the managers to improve the companies. And that is good not only to reduce risk, as Candace was saying earlier, but we think is also going to be a great way to increase the probability of a successful exit, and possibly at a premium. So nobody wants to invest in a dairy farm in Kenya that is a quote-unquote dirty company. Danone, which has done a number of recent acquisitions in Africa, has gone into dairy farms that had actually been professionally managed with the assistance of private equity funds.
Yeah. Thank you, Paul DeFerner from CBP. I also used to be president of a large philanthropy in the United States. And one of the things we always wrestle with, still wrestle with, is, the wealth that we receive. This is building on the morning and what Elizabeth was saying about policy and policy makers. It's not just bringing your money into development agenda, but, are there gaps? Do you have dueling data? Do you have dueling expertise? Do you have, where's the welcome mat? Where's not the welcome mat? And how do we align the timelines of government, which has to return in a governmental way, return financial and social, with your rates of return, which are also much more rapid, probably, in terms of what they expect. So it's a question about, how do you pose this with the governments in the countries where you're investing?
So I'll jump in, and I think from our side, we don't work directly with local governments. We need to understand what the regulatory framework, what the government policies are that affect the institutions that we lend to in country. And in the cases, we do have one of the funds that we manage is a private equity fund that invests in equity. We have another handful of equity investments, and when we're at that level, when we're making those investments, it is incredibly important that we understand what the position of the government is, both in terms of supporting the industry that we're investing in, as well as the rights of shareholders and rights of foreign investors in country. But we don't typically have a policy dialogue. Certainly, I think that the appropriate place for that to be had is with the DFIs, where you can have that dialogue kind of among the policymakers and governmental institutions, and to support also local organizations that may be forming around the local, microfinance or organization of microfinance entities. So I don't have much to add there. I don't know if Peter, if you wanted to.
Do you mean particularly local currency, local countries, the countries in which we work specifically, or more the
Yeah, I guess,
institutions?
if you're mostly back office, it may be less relevant, but, in fact, you want to work with organizations on the ground who are affected by local policy. And, my experience is it tends to be, quote, suspicion of, sort of certain kinds of investments that purport to measure social impact and sort of proselytize in a way about that when you have government experts who claim that they understand better.
Most of the places we work, we don't have a lot of interaction with the local governments, to be quite honest. There's some regulatory issues that we need to deal with if we're in country and we want to get money out of country and repatriate the loans that get paid off. But I'll take the opportunity to note the irony that the countries in which we operate are countries in which governments provide virtually no subsidy to the agricultural sector, whereas the countries in which we live provide a massive subsidy to the farmers in which we live. During the Brexit debate in the UK, one fact that emerged that I was surprised by is UK farmers receive 50% of their income from EU transfer payments. What would that do to yields in the developing world if their incomes went up by 50% by government transfers? What we do find though is that in many of the countries in which we operate, the local financial institutions are so hamstrung by regulation as regulated local banks that they don't lend money. They basically take deposits and buy government debt. And that provides both a need for people like us to come in and provide some financing on the ground, as well as potential partners with those local banks to the extent that the people with whom we work need local currency financing and access to local depository institutions.
I think that's a fascinating question and a very good point, Peter. So this morning, very briefly, I think it was Elizabeth who mentioned the Addis Ababa third conference, Investing for Development or Finance for Development, that took place last year. And we were honored. The Canadian government had invited Sarona to join them officially. And it was the first time ever that in a room you had governments and country representatives, you had civil societies, and you had the private business sector represented by the World Economic Forum and a number of representatives such as Sarona. And what was amazing, you're absolutely right, there is a legacy and a history of tension between governments thinking that the private sector is out to rape and pillage the local community, and distrust by the private sector of the government ability to actually efficiently deploy capital, and the civil society trying to do their best but with very limited resources. And so it was fascinating, because I would say, well, every long journey starts with the first step. What I saw in Addis was that for the first time, it was the beginning of a start of a consciousness that three groups have to start learning each other's language, to work together in order to solve the problems that have been very helpfully brought together into the Sustainable Development Goals. And if we could together start to understand each other and trust each other a little more, frankly, we can do a lot more than we have done in the past. And what Peter was saying in terms of governments, we at Sarona invest through local private equity partners in companies, equity. We try to invest in companies that are as far away from local governments as we possibly can. Because in those companies, there's two big risks associated with governments. One is corruption, and the other one is that if you are too successful and your project is too big, the government will nationalize it. So the way that we try and generate returns at the right level of risk with the right amount of impact for our investors is by investing in businesses that are producing locally for local demand and flying below the radar screen of any government intervention. And doing that, we hope that we're going to do the right thing.
So this is a question for Melina. You mentioned the focus on low and middle income countries, and it seems like sort of growth stage, local entrepreneurs. Have you, and I wonder how you feel that would help these different programs in a way and stabilize and come to perhaps regions around that? Have you been able to assess progress along that front a little bit, or broad and
I wish I could say yes. It's a drop in the bucket. The big players historically in the development financial institutions, there is a lot of research that has been done by think tanks like the Brookings Institute and the like. Our evidence is anecdotal, but so I'm Italian. I work for a company that has offices in Amsterdam, where I'm based, and Canada. We invest across Africa, Asia, Latin America. All I can tell you is that from Italy, we have this flood of refugees, coming from Africa. Instead of trying to sort the problem, which needs to be sorted at the borders, how much more useful and impactful would it be to create jobs in the countries from which they come so that they can have a future, so that they can educate their children, they can buy healthcare locally instead of having to risk their lives on a overcrowded little dinghy across the Mediterranean. So anecdotally, we think that by investing in growth stage companies that create more jobs and better jobs, and better services and financial inclusion, people will find a future at home. And that's anecdotal evidence.
So have you invested in any individuals developing technology locally? Are there any technology companies that you've invested in?
Well, as I mentioned, we invest in funds. Have any of our funds
funds,
invested in any innovative technology? We don't do venture capital. Or rather, we don't invest in funds that do venture capital. So innovative technology.
What I'm talking about is, you could get coders.
Fintech.
You can have coders anywhere in the world. You have people developing code in Eastern European countries that can be used for applications, and these kids are all over the place. So what I'm talking about is you have smart kids in less developed countries that actually have, in some cases, access to learning technology that could be developing technology that can be applied to different types of problems that can be solved. So what I'm saying is, within your private equity investments, is there anything in that area that they've been able to identify, because it could be an interesting area going forward?
It is a very interesting area. I would say that the closest we have come to is companies that have actually developed mobile payment technology, especially in Africa. We have invested in e-learning companies that have been fabulously successful. But again, it's always in companies that have already proven business model, post-revenue, post-profit. So yes, we recognize that there is very talented people doing really exciting things. And the growth in those countries and the opportunities in those countries is so much greater than elsewhere. So those are the kind of things.
You talked about measuring impact, and some people say the reason it's so hard is that impact is such a relative term. It's like trying to define what's good. And I'm wondering, do your investors agree on what impact is? I'm looking for some common denominator and where that starts, and is that the right place, or are there other places?
So I would say that our investors, and I don't even know how many there are these days, but I don't know, 100, some 150, probably each one of them may have a slightly different view on what really means. They all understand that the sector that we are invested in, which essentially, if you think of it in a broad term, is really investing in the growth of capital markets in developing countries to really provide the tools for local entrepreneurs at whatever level, whether they're micro entrepreneurs or small business people, to have the capacity and access to capital to build their own economic enterprise. That's impactful. But each of them may have in their own portfolio the way that they think about it, or what their particular way of defining impact may be quite different.
So our investors come in lots of different stripes. We've got senior note investors who lend to us for short periods of time, subordinated debt investors who lend for longer periods of time. We've got true philanthropy. We've got fund management partners. We have people who participate in our loans, right? So almost all of them have their own view on what impact is, and it's not one view. Some people that we deal with think that their view should prevail widely. That hasn't happened yet. But I'd say that if there's a common thread, the common thread is that all of our investors want us to have our own view of what impact is. They want us to hold ourselves to a discipline, to pick a definition that's meaningful to us and to run our business that way, and to express what we're doing in terms of the impact we're trying to create.
We have time. If the borrowed watch is accurate, we have time for one more question.
Hi, Alyssa McCarter-Laborde. I'm with Communities in VITAS. VITAS is a small business lender in the Middle East. And I just wanted to pick up on something from the last session and get your views around, you mentioned a couple times, how do we broaden the circle? How do we get more impact investing where it's not such a niche field? And each one of you in different ways are raising funds, right? Trying to tap different sources of capital. So I just wanted to hear your perspectives a little bit more on what are the obstacles for financial advisors. There's not enough product, there's not the right product, that there's not scalability, the technology platforms don't really work, it's very customized. I wanted to hear kind of what your experience has been, and if you have views on how do you break through some of those obstacles. Access and liquidity, I mean, there's so many obstacles that I'm not quite still sure, like what's the... How do we make more friends?
Trying to wrestle your question at the ground here, it's not very easy. Because I think there are lots of products out there, and maybe this panel is a symptom of the problem that you raised. We speak on a broad range of investment alternatives by risk, impact, return, liquidity. And we kind of have a common language, but the common language doesn't have agreed meanings, right? We mean different things when we say impact investing. We mean different things when we talk about impact. And I think that's probably the biggest obstacle to bringing in new sources of philanthropy and investment. And I don't have, my panelists undoubtedly will have better ideas than I on how to solve this problem. How's that for stitching it up?
So I think that for us, as we struggled with how to address that particular issue, one of the primary hurdles that we had to get over was how to offer a product for an institutional market that, or a new market of new investors who weren't really sure what they were getting into, who hadn't spent 15 years developing their impact agenda and had a very well-formed view of exactly what they wanted to do. And for those investors and for the advisors advising them, the question really was, is there a structure? So a lot of this was structural. Can we offer a product that offers sufficient liquidity that mitigates some of the risk that they may see going into a new sector or advising their client on a new sector? So that, in being able to offer an open-ended fund with liquidity features was an innovation for us, kind of moving away from a closed-end private equity fund where you have all the capital coming in over a certain amount of time and then you've got to liquidate it all and wind up and start all over again, because as a fund manager that's very difficult. So I think that some of this is product. I think it's being able to demonstrate track record. So, and what we've heard, and I'm not the primary person that's out there kind of doing our investor relations with for our team, but I do meet with investors periodically, and we often kind of hear this is something that we think we want to be able to advise our clients on, but we need to have more. We need to have more options for them, because otherwise it just seems like such a tiny universe that it's too high risk. So it's a bit the chicken and the egg, I guess, situation of how do you get more options out there.
So I was delighted to hear this morning that, Peter says there is too many different products out there. I would say there is too many requirements from investors out there. So we heard it from some of the advisors. There is a fragmentation of wishes and needs and a very narrow, often, set of requirements. So, if you want to invest in a fund that builds water wells in Guinea, well, that is not a scalable business, and we cannot create that kind of product. For an advisor to try and please an investor that wants, to help, I don't know, help me out with an example that doesn't offend somebody.
You're on your own.
But you know what I mean. It just doesn't work. So there is still a lot of, but these are good problems to have in a way, because it means that together we're all thinking about, there is a need and a demand from investors, there is a need and a supply from managers and advisors. We now have to make sure that they're not tiny little tentacles trying to reach each other, but that they become two big hands, and that they can shake and they can go together, because at the moment it's just too fragmented on both sides. And so, Microvest came up with an innovative creative product that offered liquidity. Sarona tried to say, okay, you need intermediaries, because you large asset owners are not going to be able to invest in the fund that is going to invest in the entrepreneur that needs the capital. You need somebody that aggregates all these opportunities and gives them to you in a turnkey, solid, competent, trustworthy fashion. But we're not there yet.
There are questions.